Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Nodal Pricing and Power Plant Location Decisions. We are grateful for David Brown from the University of Alberta for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find on our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our presenter. First, this webinar is being recorded for those that cannot participate in today's live event. If you have any questions for the panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I would like to introduce you to our presenter, Dr. David Brown, Associate Professor at the University of Alberta. David, over to you.
Hi, thank you. Yeah, let me share my PowerPoint here. All right, so thank you. I hope everyone's doing well in these strange times. So today I'm going to give a talk on a paper that is joint with Jay Zarnicki and C.K. Wu. And the paper is titled, Does Locational Marginal Pricing Impact Generation Investment Location Decisions? An Analysis of Texas's Wholesale Electricity Market. So what we're going to do today is I'm going to go through my presentation in 20 or so minutes, and then I'm going to kind of open up to any question and answers that you have. So feel free throughout the talk to write any questions that you have in the box, and I'll hopefully be able to get to them all by the end. All right, so let me here. Yep, there we go. Okay, so what I want to talk about today is kind of a key objective of restructured wholesale electricity markets is to kind of facilitate trading between generators who are trying to provide electricity. A key aspect of that is price formation. So a key center of facilitating trading between generation facilities is allowing for a competitive price to determine the balance of supply and demand. So as many of you know, because you're listening to my talk, electricity is complicated in the sense that supply has to always equal demand at every instantaneous point in time. There's an inability to store electricity at relatively low cost, and again, things are changing, but historically this has been the case. And there's a big high cost of supply shortfalls. So these unique characteristics and unique factors, combined with the fact that we have competitive markets in a lot of jurisdictions, motivate the value of competitive price formation. And another complication associated with this is prices are very time variant and potentially very location variant. So a big fundamental component of electricity markets is that prices should both reflect location and time value or time varying characteristics. A centerpiece to ensuring this is satisfied is something called locational marginal pricing or nodal pricing. And in all jurisdictions that are restructured, at least in the United States, I know Europe is quite different. They have different structures, but at least in the United States, we have locational marginal pricing. And the big objective of that is we're trying to allow wholesale market prices to reflect both the time varying cost of generation and accounting for these physical network constraints. And electricity markets are strange in the sense that we have to bridge the gap between engineering constraints and economics, right? Well, locational marginal pricing is often viewed as a central component of bridging that gap. All right, so absent transmission congestion, and again, our analysis is on Texas. So absent transmission congestion, locational marginal prices or nodal prices are going to converge across all nodes. So the figure to your right is going to be a map of ERCOT, of Texas's electricity market. All the little red dots are nodes. So absent congestion, that heat map is going to be all one color. So the LMPs or the nodal prices converge across all nodes. But when congestion arises, basically the lower energy is unable to transfer or flow across the electrical lines to these higher cost nodes. And what ends up happening is with nodal pricing, we're going to elevate the nodal prices at the nodes that have these transmission constraints. Well, the map again to your right shows a day from last summer. So I don't know if you paid attention to Texas's electricity market, but it was really, really hot in August. So the map to your right shows that, we have this large dispersion of LMPs. So in some parts of Texas, so lower Texas, the prices were as low, and again, this isn't low, but as low as $300 per megawatt hour. In regions like Houston, where it's really deep red, you have prices above $1,000 per megawatt hour. So these nodal prices are trying to capture, not just the time varying cost of electricity, but the fact that providing electricity in jurisdictions like, say, Houston in this picture are higher costs than providing electricity to Southern Texas because of these transmission congestion problems. So naturally, there's going to be an array of academic and industry work that asks the question, what are the benefits of nodal pricing? So there's a large number of studies, or a sizable number of studies, that show that nodal pricing can reduce congestion, improve the dispatch of generation resources, and reduce reserve requirements. So a lot of this comes from kind of the engineering and the operational improvements of allowing prices to vary by node. So there's been several papers that look at these questions. So what do we do in our paper? So another often cited benefit, and you're going to see if you read any paper on nodal pricing, you're going to see this cited as a potential benefit of nodal pricing. So another benefit is it's going to send price signals for generation investment location decisions. So what do I mean by that? Well, if I locate and imagine this trend that is in this graph held more broadly, if I locate in Houston, if I build a generation unit in Houston, if the price patterns look like this every hour, then I would get more payment by operating in Houston. So it's rather intuitive, right? If I'm located in a region with high nodal pricing, then I'm going to expect potentially higher revenues. Well, surprisingly, this was a question that Jay and CK and I talked about a while back. And surprisingly, there's really limited evidence that tests this hypothesis. In part because this is a really, generation investment decisions are a really complicated decision, right? So there's relatively limited work, at least that I know of, that tests this hypothesis. So the goal that we wanted to investigate with this paper is we want to see, okay, can we do something? Can we investigate a relationship between locational marginal pricing and generation investment decisions? So what we do is we look at recent generation investment decisions in Texas and ERCOT, their wholesale electricity market, and we want to ask the question, is there any empirical evidence at all that there's a positive relationship between LMP and nodal prices and the location choices of generation facilities? All right, so what do we do? So we look at generation investment and locational marginal prices from January 2011 to June 2019. So when we got the data, that's when we could get the data up to June 2019. So over our sample period, what really makes Texas interesting is, unlike a lot of jurisdictions, over our sample period, electricity needs have increased about 2% per year. In combining that with the fact that we have observed some retirements in Texas of old generation facilities, we actually observe a substantial amount of investment in generation capacity over our sample period. So sorry, I'm trying to make sure we're good here. The chat, yeah, okay. Sorry about that. So we observe a substantial, and I'll show you 42,000 megawatt hours of investment over our sample period. And in addition to that, while we look at January 2011, ERCOT has had nodal pricing since December 2010. That's a nice feature as well. I'm not going to get into the technical aspects of how resources are dispatched, because A, I'm not an engineer and I would embarrass myself, and B, that's beyond the scope of the paper. All I'll say is, there's really smart engineers and economists out there that dispatch resources using a real-time algorithm that accounts for transmission constraints. This determines locational marginal prices at every little node that I showed on that graph every 5 minutes. The one feature that, I, or a lot of people, not just me, view as a nice aspect to analyze these questions is Texas has an energy-only market design. And effectively what that means is power plant decisions are not complicated by these other payments. So those of you familiar with electricity markets will know there's other payments for generation capacity with capacity markets or resource adequacy requirements. Texas, as an academic researcher, makes it a lot easier because they don't have any of that. And locational marginal prices can rise to as high as $9,000 per megawatt hour. All right, so what do? We utilize data, we aggregate the LMPs to the 15-minute level. We look at January 1st to June 2019, January 2011 to June 2019. We have market level data on demand, natural gas prices, generation investment, and generation output by technology. We have the location of all nodes in Texas. We use QGIS, so a mapping software, to map the distance from each resource to existing nodes. We're going to avoid selection into our sample by looking at nodes that existed as of January 2011. We're going to match each generation unit with its nearest node by distance, and this is going to proxy for the most relevant LMP. We're extending this to look at the distance across the transmission line, again using mapping QGIS software to do a robustness check. We use the Energy Information Administration's data on all generation investment greater than 1 megawatt in Texas. This provides unit characteristics, the location, and the operating month and year. We're going to focus on investment after 2011, January 2011. We're going to hone in on four key technologies. We're going to look at CTs, which is kind of peaker, smaller natural gas units. CCGTs, which are larger, lower marginal cost gas units, wind generation investment, and solar investment. All in all, in our data set, we have 319 new generation assets, where 71% of them were operating by June 2019, so at the end of our sample period. All right, so as I mentioned, analyzing investment decisions is a really complicated task, right? They're long, complex investment decisions. And our goal is to see, is there any positive correlation between LMPs and where they locate those investments? So what do? Well, we take actually 4 approaches, and I want to highlight all 4 of them. So number 1, you have to ask the question, is there any dispersion in nodal pricing? If there's no dispersion in nodal pricing, then there's no opportunities for generation resources to locate in pockets with high prices, high nodal prices. So we're going to evaluate the degree to which LMP-driven investment could have actually arisen in Texas over our sample. Then we want to ask the question, we want to evaluate whether investment location decisions are concentrated near nodes that have observed high LMPs in the past. And this idea is basically, there's a strong belief that LMPs, so nodal prices, send a signal that, hey, we should invest in this location. So we're going to decompose investments into these pricing quartiles based on lag nodal prices to address this question. If investment often occurs in these high nodal price, historically nodal price locations, then this provides some support that nodal prices nodal prices send investment signals. So we want to test this using some descriptive measures. And lastly, in terms of descriptive measures, we want to ask the question, we want to compare LMPs at nodes with and without recent nearby entry that occurred in prior periods, and ask the question, do nodes that have observed recent investment have a premium after the investment occurred? So basically, this is trying to ask the question, do assets located in regions with high nodal prices And after they enter, are they paid on average more than nodes that did not observe investment? And the idea is basically, if nodal prices, if we're trying to locate for getting higher nodal prices, you would expect there to be an LMP premium post-entry. Basically, you're getting paid more in nodes that are, you're locating in nodes that have higher prices after entry. That would be consistent with the hypothesis that, nodal prices are driving investment decisions. And lastly, we do a kind of formal regression analysis. And this analysis is based on a relatively simple illustrative model of investment. So start at stage 2, right? After entry, the firm sells output in the real-time market. You would imagine, obviously, that expected profits of operating are going to be increasing in expected locational marginal pricing level. And there's empirical literature to say that as the variance of LMPs rise, the expected profitability is going to rise as well, because there's a higher incidence of higher prices. The investment location decision occurs in stage 1. I'm going to form expectations of my net present value of operating an asset at each node. A node is more likely to be selected if it's expected to have higher and potentially more volatile real-time market prices, but lower capacity costs. So what we want to do is we want to establish a relatively simple regression analysis to kind of simulate this idea, right? We want to simulate what is my expected LMP level and expected LMP variance, back up and say, in nodes that have higher expected LMP levels and variances, do we observe a higher probability of entry? All right. So to simulate that simple illustrative model, let's do backward induction here. Let's solve it backwards. So what we're going to do is in stage 2, we're going to use observed real-time nodal prices to simulate out expected nodal prices going forward. So how do we do that? It's a pretty complicated thing. So for each node, this is our best attempt at it. So for each node, we're going to create a regression model to simulate expected nodal prices. So we're going to regress nodal prices on market level controls, natural gas prices, and some calendar dummies. What this is going to allow us to do is simulate out of sample what are future LMP levels and variance. So how do we do this? Let me give you an example. So we're going to estimate a model, say on data from 2011 to 2013, to estimate a model to forecast hour or 15-minute LMPs, nodal prices. Then we're going to use this fitted model to estimate LMP levels and variances out of sample for 2014 to 2019. We're going to use this to proxy for a firm's expectation of, if I enter into this node, this is my expectation of the LMP price level we're going to get and a potential variance that I'm going to face. So we do this on pre-entry data, say 2011 to 2013, and we use this to proxy for a resource. If I invest in 2014, this is the trajectory of LMPs that I'm going to face. Then we move back to stage 1. We use these estimated regressors to ask the question in a binary Logit model. I mean, whatever on the technical details, but effectively, we're trying to ask the question, is the probability of entry of a technology at some node in some year related to average LMP prices and LMP variances? And that's what this regression is doing. So we're going to see, is there any positive relationship between these covariates? We're going to control for a year because a lot of things changed over time. So we're trying to control for changes in market trends. We're going to control for zonal fixed effects to try and capture the fact that building in different regions of Texas is going to cost a lot different. It's going to cost different amounts because of different characteristics of the land, the cost of land, etc. So we throw zonal fixed effects to try and soak up that location-specific issues such as cost of building a power plant. All right, so let me spend hopefully 10 minutes on the results. All right, so basically what do we observe here? Well, we observe, not surprisingly, if you've paid attention to ERCOT, we observe a decrease in the average nodal prices by quarter. This is the left panel is average LMPs by quarter. So we're looking at a declining LMP, and there's many reasons for this. One is we observe a decline in natural gas prices. But while LMPs were declining, if you look to the right-hand side, this is our measure of dispersion. So we take a bunch of measures of dispersion, the difference in the 75th to 25th percentile nodal prices, the variance of prices across nodes, etc. The Gini coefficients, used a lot for income inequality. If you do a Gini coefficient equivalent here, it's measuring the deviation, the differences of all nodes from each other in every period. So what we observe is there was quite a bit of variance in 2011. It declined in the middle of our sample. So in 2014, we're at the trough of dispersion. But consistent with observed congestion costs that we've observed in Texas, there's an increase in dispersion in recent years. So this suggests that maybe in the middle of our sample, we don't observe a substantial amount of dispersion. But near the end of our sample, we do observe an increase in the degree of dispersion. So this provides some suggested evidence that, hey, there is an increase in the degree of LMP dispersion over our sample period, suggesting that there might be some scope for LMP-driven investment. Let me show you a graph of how that's going to look. So this is in 2018, 2019. What this is average nodal pricing at every single node across the year. And this just gives you a picture of approximately the type of dispersion that could arise in Texas. So what we see here is prices could be as low, so up in northern Texas with a lot of wind facilities, as $10 on average. In western Texas, it could be as high as $250 on average. So we do observe, especially in recent years, a higher degree of dispersion. All right, so let's do observed investment. So not spending a ton of time because there's a lot of information here. As I mentioned at the outset, there was 20,000 megawatts of wind investment. There was approximately 14,000 megawatts of natural gas investment, the vast majority of it being larger scale CCGT assets. In recent years, we've observed a growing amount of solar investment. And in fact, the EIA data doesn't have in the queue all the solar assets that we observe in the ERCOT queue. It's just a problem, I guess, with the data. But again, we've seen an increased amount of solar investment. All right, so the first result I want to present is, remember the question I wanted to, we wanted to ask, I should say, was basically, do we observe investment at nodes that have had recently high prices? So this graph to your right is showing capacity investments by the lagged 3-year nodal prices. So basically you take the average of nodal prices over the last 3 years, divide those up into different quartiles, and look at where the investment occurred in those different quartiles. There's a bunch of ways to slice and dice the data. I'm going to just go ahead and say that it doesn't matter the way we sliced and diced the data. The graph all tends to look like this. So what this graph shows is the largest quantity of megawatts of capacity were actually added in the highest price tier. So what you could say is, looking solely at this graph, this provides some evidence that the most frequent investments occur at nodes that have had historically higher nodal prices. But if you zoom out a little bit, you could look at this graph and say something else, right? You could say, well, hey, you know what? The lowest 2 price tiers, so the bottom 50th percentile, actually had more investment than the top 50th percentile. So our takeaway from this graph is basically, there's mixed evidence here to suggest that, historic nodal prices drive generation capacity investment location decisions. So there is some evidence that we invest in higher historically nodal price jurisdictions, but it's not a slam dunk here. All right. Well, remember the third piece of descriptive evidence we wanted to show is the average nodal price at nodes that have observed entry higher post-entry the nodes that did not observe entry. And basically this allows you to ask the question, if we're investing largely for nodal pricing reasons, you might expect a premium after entering. So looking at this is a simple comparison of averages, right? So all we're doing is the average price over our sample period, and the non-entry node is $29. Looking at, I'm going to look at the different technologies. Across all technologies, they're lower on average. Looking at CT technologies, they're $27 on average. The difference in means, again, a really simple descriptive analysis, is not significant. The largest decrease in average nodal prices occurs with these larger natural gas facilities. They're $3 lower on average, and the difference in means is significant. Wind and solar are also lower on average, and those results are the averages. Again, be careful because this is just a comparative descriptive analysis, are lower on average. So again, this is one presentation of the results, but we did a bunch of different versions of this table and find that there's relatively limited evidence of post-entry LMP premiums. And in fact, these results are consistent with potentially suppressed LMPs post-entry. And the reason why I say that is, notice the largest decline is the largest assets, right? These large natural gas assets, you actually observe a reduction in the average nodal prices. So you might say that this is more consistent with suppressed LMPs post-entry, rather than I'm getting this premium after I've invested. Okay, so and again, I'm trying to leave a lot of time for questions here. So this is the second stage binary Logit model. And what this basically, again, remind yourself, is it's the probability, it's trying to approximate what's the relationship between these covariates and the probability we observe investment at a node, right? All right, so what does this show? Well, looking across all technologies in column 1, we do observe a positive coefficient on average LMPs. Well, let's take a second here. This is average LMPs across all hours. And looking across all technologies is actually kind of misleading, right? Because you have natural gas, you have solar, you have wind in here. So it's important not to look at all technologies. Well, let's hone in on a couple of coefficients here. CTs, again, these are small peaker gas assets. So the positive and significant coefficient when we look at all technologies is largely driven by these small peaker gas assets. So we do observe a positive relationship between CTs, the average price at a node, and the probability of investment of a CT natural gas unit. But if you decompose that by time of day, so looking at average nodal prices across the day can be quite misleading, right? Because the profile of nodal prices can vary substantially over the day. Well, we also decompose the results by the time of day average nodal prices using our forecasting out of sample method. If you do that, you get a more nuanced story here. So basically what we find is the positive coefficient on the natural gas, the CT natural gas units, is driven by, in the evening hours, when we have nodes that have higher evening hour nodal prices, we observe a higher probability of investment in small natural gas assets. So taken together, this suggests that there may be a positive relationship between probability of entry at a node and high prices in the evening hours for peaker gas units. And this actually kind of makes sense. This does make sense. What I would say though is this significant coefficient, as we always do, rely on the stars next to the coefficient. This significant coefficient is sensitive to the specification. So we tried a bunch of different models. This is looking at the nearest node. We tried a bunch of different models, and this significance starts to go away depending on how we define this spatial measure of being near a node. So I will caveat this coefficient by saying it is sensitive to the specification of the model. All right, what about the other technologies? We actually don't find much, and actually we find contradictory stories, and let me talk about why. So breaking down the CCGT, the larger natural gas units, we actually observe a negative coefficient here. So what this says is there's a negative relationship between the average nodal pricing in the middle of the day and the probability of entry. And this is kind of exactly the opposite of what you would expect. So what this led us to do was to dig into why would this coefficient be negative? And our belief of what's happening here is if you look, if you go on Google Earth and you map out every single CCGT unit that was built in Texas, what you actually find is they tend to locate in nodes where there's already existing CCGT units. So I'm going to locate in a node where there's already existing large natural gas facilities. Well, what happens at those nodes? Those nodes have lower average daily prices because we have a lot of generation capacity already existing there. So so we view this more consistent with the argument that we're locating in a region for reasons other than high nodal prices. In particular, it's easier to build in a facility with existing natural gas units. This is not consistent with a story that we have a positive relationship between nodal prices and the probability of entry. This is kind of a other driver of investment is what this is consistent with. The last thing I'll talk about on this in our main kind of regression specification is solar. You also find a kind of odd relationship between nodal prices and the probability of entry at a node for solar. Again, you get a negative coefficient in the middle of the day. So the time of day 3 is smack dab in the middle of the day. What this suggests is I'm actually more likely to locate in nodes that have lower prices in the middle of the day and higher prices in the evening hours. What we actually think this is picking up is the fact that we observe solar resources. Again, you go into Google Earth and you plot out where all these solar resources are locating. You observe them co-locating in regions with better solar potential and cheaper land, etc. So this is the opposite relationship you would expect is, when the sun's setting, why do we observe a positive coefficient here on the time of day 4 and 5 coefficients? Well, it's because we actually see solar resources co-locating in these lower priced nodes that are lower priced in the middle of the day when the sun is shining and solar is producing, and higher prices in the evening when the sun's setting and solar output is decreasing. So actually, this is more consistent with co-locating in nodes that actually have existing solar and lower prices on average because of that. So taken together, I'm throwing a lot at you here, and it's hard to decompose something that we've worked on for a year in 5 minutes. But taken together, there's limited evidence, and in particular in CT, the small natural gas units, there is a positive relationship between the prices in the evening hours, these peak hours, when we would expect these resources to generate, and the probability of entry. For other resources, we actually observe the opposite relationship. And this is more consistent with the story of I'm locating for other reasons. I'm co-locating at a piece of land that's just easier to build on, or I'm locating in a piece of land that has better solar potential and is cheaper. So I'm going to conclude, and then we can open up to any questions you have. So we observed, declining levels of LMP, but actually increased dispersion of LMPs, suggesting there was potential for LMP-driven investment. We document substantial investment in wind and natural gas over the sample period, especially they're both pretty evenly distributed across the sample. The largest number of new megawatts arise in the top 25% of lagged LMPs. But again, that's looking at it through rose-colored glasses. You could also say, but most of the investments occurred at nodes in the lowest 50th percentile. So it depends upon how you want to interpret that. So it's kind of mixed evidence of historical LMPs driving investment location decisions. There's limited evidence of a premium of nodal prices post-entry. And in fact, we kind of find the opposite. The statistical analysis, it's relatively simple. I more view this as this suggests that there's limited evidence that expected average LMPs drive investment location decisions. I think you need to build a much more complicated structural model to fully disentangle that relationship, because there's a lot of complicated directions here. But this provides some initial evidence that there might not be a lot of empirical evidence to back this up. There is some evidence with CT gas, so smaller gas assets, and expected average LMPs in the evening hour. But as I mentioned, and I didn't show here, but this relationship is quite sensitive to the way you define the model. So this will be my last slide, and then we can have any questions. So conclusions that we take away from this is, maybe nodal prices, even though it's very straightforward to think why nodal prices would drive investment location decisions, maybe nodal prices is not the primary driver here. There's a lot of other things, investing is really complicated. There's a lot of other things that could drive the decision of locating a new generation facility. So site availability, transmission access, the cost of interconnecting to the transmission line, the access to fuel or renewable resource potential, local regulations and approvals is, not something I'm an expert at, but I know it's incredibly complicated, right? There's a lot of regulations and approvals you have to go through. Another thing we should think about is, nodal prices are quite volatile. This may actually hinder if I'm trying to build a large, several hundred megawatt facility, that's going to cost millions and millions of dollars. It's going to be difficult for me to get project financing based on the expectation that I'm going to get higher LMPs than average. Second, kind of in related to that, if I build a large natural gas asset in a load pocket that has currently high LMPs, we actually may see a collapse in the nodal prices due to this large lumpy investment, right? Because I'm easing this load pocket's constraints by building this investment. So there's a risk that you're going to no longer accrue these potential benefits. And this is consistent with kind of what we're finding is a reduction in nodal prices post-entry. Nodal price spikes are pretty infrequent. So LMP-driven demand response or demand-side management, kind of smaller capacity investments, actually might be more cost-effective than building a several hundred megawatt generation facility, purely to get these higher nodal prices. There are other technologies out there that might actually be a better target for LMP-driven investment. And this naturally suggests another paper, right? Do we observe demand response and demand-side management locating in jurisdictions with historically higher nodal prices or higher expected nodal prices? And the thing I'll end with is, if there's a threat of transmission line construction, so if I'm hinging on getting higher nodal prices, but I'm worried that the congestion is going to ease because of a new transmission investment, this potential threat of a new transmission investment could reduce my, likelihood of relying on my expectation of higher nodal prices. Because if I invest here in the expectation that I'm going to get higher nodal prices, but a new transmission line is built and eases those higher nodal prices, then I've lost a lot of money, right? Because I'm building my generation facility here on the expectation of higher nodal prices. So the threat of transmission construction can reduce the load pocket's high LMPs, and that could raise a lot of risk for me if I'm investing in a generation facility. All right, I definitely did not do the time I was hoping, but I got through everything. All right, so I will pull up your questions here, which I appreciate your questions. All right, so give me a second here. All right, so Grant asked the question. So let me answer live. I think this is how it works. So Texas didn't always have LMPs. Could you test investment trends before and after LMP and implementation? So that's a super good idea. So unfortunately, I don't have, so the answer is yes, we could, for sure. But I don't have LMP data I don't have price data prior to January 2011. But you're totally right. We could look at the investment trends before this period occurred and ask the question, do we observe different patterns in investment? And in fact, we did not do that. So let me write down. So look at old LMPs. And again, they're not going to be LMPs, they're going to be zonal prices, but we could look at lagged prices for sure. So we did not do that. Okay, so some of you I know, so hello. So Raul, do you think that the CRES transmission project had an impact on location decisions? So it was completed in 2013. So we did worry about this for sure, right? Because this is a pretty serious concern. So the CRES transmission line project, basically the objective of it is to connect, wind generation from northern, the panhandle of Texas to the demand pockets, Dallas and other parts of Texas. That could affect, and that did affect, there are papers that look at this, that did affect the nodal pricing structure over Texas. So it could affect location investment decisions. What I would say though is we do try to control for that. So let's look at my slides here. We do try to control for that by including, and I don't have it here, but we do include year controls to control for these trends over time, because we were worried about the fact that a lot of things were changing over our sample period, right? So we got to control for that. So we do include year fixed effects. We also sliced and diced the samples up, right? So we also dropped investment, which there was a lot less investment prior to 2013. We also looked at investment 2013 and after, in the hopes that we were only looking at investment at LMPs after CRES arose. So between looking at a subsample of the data and year fixed effects, we were trying to control for the potential impact of a large transmission investment in 2013. So I totally agree with you that could be concerning. But again, we think we did deal with that pretty well, but there's always room for improvement there. Okay, so another question was, did you consider, let's answer this one, did you consider the transmission plans by the system operator at the time of investment? Transmission reforce plans could impact an investor's expectations that LMPs could receive and could be an input into stage 2. So that is something that we did not explicitly look at, but we can definitely look at planned investments. And I'm trying to think of how exactly we would do that, but that's definitely a good question. So I think we should dig into, what were the investment plans that were arising during our sample. But again, we got to think a little deeply of how exactly we could look at that. And that could be maybe considering slicing our sample up to think about what potential impacts those could have. Okay, so Lucas, thank you. So can the prices 3 years lag divided by tier be somehow related to the type of generation technology? This way, for example, different generation technologies can compete in different markets. For example, peakers in high paid markets and CCGTs in the first pricing tier. So you're right, the 3 year lagged approach was just one way we divided the sample up. So I understand what you're saying, and I agree that these results, these 3 year lag results could be sensitive to the definition of lagged, right? So we actually did a lot of slices and dices here. 3 year lag, 2 year lag, 1 year lag. It depends upon, what we're trying to capture here. And shockingly, however you lag these results, we actually found that it didn't really matter. We still find, if you look at the single most investments by megawatt, they still did occur at the highest price tier, for regardless of the lag we considered. We also did this by technology as well, and you get a very similar pattern, which we kind of were surprised by. So by technology and by the definition of lag, you actually find a very similar pattern. The point estimate, the highest quantity, does arise in the highest pricing tier, but if you look across the distribution, you still find actually the lowest 2 pricing tiers observe the most investments. And this I think is also driven by a lot of wind, right? we do observe a lot of wind investment. That's what this graph could be clouding the technology factors here. So we do observe a lot of wind investment, and you're right, a lot of the wind investment does occur in the lowest two pricing tiers. This relationship here is stronger, and I think this is what you're getting at, is stronger for natural gas assets. We do observe more megawatts of gas in the highest two pricing tiers. But again, the evidence is still mixed. The most megawatts in aggregate did still occur in the lowest two pricing tiers. So even if you slice it by technology or the lag, you still get a similar conclusion. Okay. All right. I am trying to get to all of these. Okay, so anonymous question. So do you have any idea how a similar, let me answer live, how a similar study could be performed for a zonal market design as in Europe? For example, by looking at redispatching cost. So again, I'm gonna have to be honest and say I don't know the European context as well as I should. So I'm unfortunately unable to answer this in a way that would be a great way to answer it. So I think what you could ask a similar question using European data, but yeah, I'm not incredibly familiar with the ways the zonal redispatching works. But you're right? You know, zonal prices are effectively, rather than having higher prices at nodes, it's a more aggregated representation where if you're in a zone that say has higher congestion, you could end up having higher zonal prices, and that may drive investment in those jurisdictions. So even though I don't know the European context enough to talk incredibly intelligently about it, I would say that I can't imagine why you couldn't do a similar analysis in the European context. Okay, so let me mention, so John Martin, so thank you for your question here. So you mentioned the threat of construction destroying high LMPs. Is there any observation of this happening over the analysis period? So yeah, so let's think about that. So what do we observe here? So this LMP post-entry that I'm showing here on this slide, I think is most relevant for your question, right? So basically what you're asking is, investment is suppressing, is investment suppressing nodal prices? Is effectively what we're trying to get at here. This is looking at all years of the sample, right? Which may actually bias the results. I didn't want to include a massive table, but if you do this exact result by year or by chunks of years, we actually do find exactly what you're suggesting here. In the early years, the comparison of non-entry nodes to entry nodes, we actually observe a relatively similar average. But over time, and in the updated version of the paper, thanks to a referee, in the updated version of the paper, we're going to include exactly what you're asking for. As the time goes on, we actually observe a larger divergence between average non-entry LMPs and entry LMPs, suggesting that we do observe a larger divergence of this LMP post-entry premium over time because we're actually observing more investment over the sample period. Okay, so William Hogan, so Bill Hogan. Let's look at your question. So a starker and complementary example is the case of ISO New England in 1998, which does not require any econometrics. In that case, it says location of investment overwhelmed the market design because it did not reflect locational differences. So comments. I'm not familiar with the late 90s ISO New England, but that's definitely an interesting example. So could you also? So factors that you analyze are suggested. All right, so I've got through most of the questions here. So let me scroll through. Sorry, it's hard to think while these questions are coming in. So please ask any more you have. Okay, so another thing that we do not, so I haven't asked a question. So could you also think about significant changes in local consumption patterns, so opening or shutting down of big industrial facilities in your study? So you're right. So what we don't have is we don't have necessarily demand at the nodal price level, which is an important thing to think about. So I agree. So one thing we could improve on, and again, I'm not sure that we can necessarily get data to control for this, unfortunately, but it could be that consumption patterns at a granular level, say the nodal price level, could be driving things, so local nodal prices. So I agree with that. I think, you know, another extension of what we do could look at this. And again, what I should say is our goal here is, you know, there's a ton you can do, right? So you know, you could build a structural model. So I've got a few questions here about controlling for other factors. So you're totally right. You know, we're trying our best here to come up with a framework to start to ask this question, right? But I think what our goal is here is we're trying to say, you know what, there's not a lot of evidence to ask this question. So let's start to ask this question. Let's kind of try to contribute to this dialogue to see, is there any relationship? And that's why in this conversation I'm having here and in the paper, we're very careful to interpret our results. We're not saying that there is a direct causal relationship or anything like that. We're very careful to say this is a relationship between investment and nodal prices. So I agree with all of you that there's other factors that we should account for here. And that just suggests that, you know, there's other analyses that should be done. You could build a more complicated structural model to better disentangle this causal link. So I view this more as a first study of a descriptive and, you know, relationship between nodal prices and investment location decisions. So yeah. So I appreciate your comments. All right, so I think that is where I'll leave it. And I agree, there are other comments here about implementing a carbon tax and other things. You know, implementing a carbon tax wouldn't necessarily affect the what about a carbon tax? Well, you know, the thing we're utilizing is heterogeneity in nodal prices by location, right? So if you implemented a carbon tax without transmission congestion, that's just going to, you know, elevate overall wholesale prices. But you're right, if you implement a carbon tax and you're at a node with an emissions intense resource, as long as they're bidding in the cost of that carbon tax, it's going to be reflected in their higher bids. So they would be reflected in the nodal prices if congestion arises. So yeah. All right, well, I appreciate you taking the time. And again, feel free to send me an email. So if you have any other questions, feel free to email me. We can email you. I can email you these slides. I can email you the paper. And again, this is kind of we're trying to start to look at this relationship here. So I appreciate you taking the time today. All right.
Thank you, David. IAEE wishes to thank you for an outstanding webinar. I know I personally learned quite a bit and much appreciate your research and your time to be with us today. If you're not already a member of IAEE, we encourage you to join by visiting us at www.iaee.org. This webinar has been recorded and will be archived on our website along with David's slides. So if you wish to revisit this on our rewind, you're welcome to do so or to share with your friends. Thank you once again, and I officially close this webinar.
Thank you.